Before you place your next trade, you need to hear this. Right now, while markets swing and screens flash red and green, Warren Buffett sits quietly on $348 billion in cash. Not stocks, not bonds, not crypto. Cash. More money than Apple, Amazon, Google, and Microsoft have sitting in their vaults combined. Every trader I know thinks he's lost his mind. They whisper that the oracle has finally cracked, that age has dulled his edge, that he's missing the greatest bull run in history. They point to their own portfolios, their quick wins, their leveraged positions, and they laugh. How could someone so smart be so wrong? But here's what they don't understand. Warren Buffett isn't wrong, he's waiting. And that difference, that single shift in mindset, separates the traders who break down from the investors who build generational wealth. You see, most traders live in a world of constant motion. Buy, sell, trade, flip. The market opens, and their fingers start twitching. Every candlestick is a signal. Every news headline is an opportunity. Every dip is a setback. Every spike is salvation. They confuse activity with progress, noise with knowledge, speed with skill. Buffett operates from a different reality entirely. While traders chase momentum, he builds momentum. While they react to markets, he shapes them. While they burn through capital seeking the next hit, he accumulates capital waiting for the perfect pitch. That $348 billion isn't dead money gathering dust. It's ammunition. It's opportunity compressed into liquid form. It's the difference between surviving the next downturn and profiting from it. Think about what happened in 2008. While traders were liquidating positions in panic, while hedge funds were collapsing, while the entire financial system trembled on the edge of instability, Buffett deployed $20 billion in a matter of weeks. Goldman Sachs, General Electric, Bank of America. He didn't just survive the crisis, he capitalized on it. That's the power of cash when everyone else is leveraged. That's the advantage of patience when everyone else is desperate. That's what traders never understand about sitting still while the world shifts around you. But here's where it gets deeper. This isn't just about having money available, it's about rewiring your entire relationship with opportunity itself. Most traders see an empty account as failure. Buffett sees cash as potential energy waiting to be converted into kinetic wealth. When you understand this distinction, everything changes. The way you view corrections, the way you handle volatility, the way you sleep at night knowing that while others panic, you're prepared. Right now, as I speak, Berkshire Hathaway owns more US Treasury bills than the Federal Reserve itself. Think about that for a moment. A single company, run by a 94-year-old man from Omaha, controls more government debt than the institution that prints American money. Those Treasury bills alone will generate $12 billion this year in steady returns. $12 billion. That's more profit than most Fortune 500 companies make from their entire operations. And still, traders call it lazy money. They don't see what Buffett sees. They don't understand that in a world obsessed with speed, the greatest competitive advantage is stillness. In a market driven by emotion, the ultimate edge is emotional detachment. In an economy built on leverage, the most powerful position is liquidity. This is the paradox that breaks most trading minds. The less you need the market to move, the more you profit when it does. The fewer trades you make, the more money you keep. The longer you wait, the better your opportunities become. But traders can't sit still. Their psychology won't allow it. They've been conditioned to believe that doing nothing is losing, that holding cash is missing out, that waiting for the perfect setup is wasting time. This conditioning runs deeper than strategy. It's neurological. Every time a trader sees a price movement, their brain releases a cocktail of chemicals designed for immediate action. Dopamine whispers about potential rewards. Adrenaline signals about immediate threats. The prefrontal cortex, the part responsible for long-term thinking, gets overwhelmed by the limbic system's demand for instant gratification. Buffett has trained his mind to operate differently. He's learned to ignore the chemical rush of market movements. He's developed what psychologists call temporal patience, the ability to delay gratification for exponentially larger rewards in the future. This isn't just about money, it's about identity. Most traders define themselves by their last trade, their daily P&L, their monthly performance. Their self-worth fluctuates with their account balance. They become locked into the emotional highs and lows of constant market engagement. Buffett defines himself differently. He's not a trader. He's not even really an investor in the traditional sense. He's a capital allocator. His job isn't to predict where markets will go tomorrow. It's to position capital where it will compound most effectively over decades. That distinction changes everything. When your timeline extends beyond the next earnings report, beyond the next election cycle, beyond the next economic slowdown, you start seeing opportunities that short-term traders miss entirely. Consider this. In the past 2 years alone, while Berkshire has been building this massive cash position, the company has sold over 600 million shares of Apple stock. Apple, the company Buffett once called probably the best business in the world, he sold 67% of Berkshire's position, collecting over $100 billion in the process. Traders looked at this and panicked. Apple's stock price was still climbing. The company was still profitable. Why would you sell a winning position? But Buffett wasn't selling because Apple was bad. He was selling because Apple had become expensive relative to its intrinsic value. He was selling because at those prices, cash earning 4.25% in treasury bills offered better risk-adjusted returns than holding an overvalued stock. This is what traders don't grasp. Price and value are not the same thing. A stock can go up and become a worse investment. A market can reach new highs while offering fewer opportunities. Success can breed the very conditions that make future success more difficult. Buffett sees these patterns because his perspective transcends daily market noise. He's not asking what will happen next week. He's asking what will happen next decade. He's not worried about missing the next rally. He's preparing for the next recession. And the next recession will come. It always does. Markets are cyclical. Boom follows slump follows boom. The only question is timing, and timing is impossible to predict with precision. But preparation is entirely within your control. That's what that $348 billion represents. It's not just money. It's preparation made manifest. It's opportunity insurance. It's the difference between being forced to sell during a crisis and being able to buy when assets are undervalued. Think about your own trading account right now. How much of it is deployed? How much is sitting in cash, waiting for the right opportunity? If you're like most traders, the answer is probably zero. You're fully invested, maybe even leveraged, because holding cash feels like leaving money on the table. But what if you're wrong? What if the market you're so bullish on experiences a 30% correction next month? What if the stocks you're holding get cut in half? What if the leverage you're using amplifies those losses until your account is severely impacted? Buffett doesn't worry about these scenarios because he's prepared for them. His cash position isn't betting against the market. It's insurance against uncertainty. It's optionality preserved in liquid form. This mindset requires a fundamental rewiring of how you think about opportunity cost. Most traders see cash as losing money because it's not generating the returns that stocks or crypto or whatever their preferred asset class might deliver. They calculate the opportunity cost of holding cash as the difference between treasury bill yields and potential market gains, but they're calculating wrong. The real opportunity cost isn't what you might make by being fully invested. It's what you might lose by being unprepared when markets turn. It's the deals you can't make because you don't have dry powder. It's the recovery you miss because you're too busy recovering from drawdowns. Here's the continued script. Buffett understands something that rewires everything. The market isn't just numbers moving on a screen. It's human psychology made visible. Every candlestick represents thousands of minds making decisions driven by fear, greed, hope, and urgency. Every price movement is the collective heartbeat of millions of traders, all convinced they know what comes next. But here's the secret that separates the oracle from everyone else. He's not trying to predict that heartbeat. He's not trying to time those emotions. He's positioning himself to profit from their inevitable extremes. When markets drop sharply, when panic spreads like wildfire, when headlines signal about significant declines, most traders do exactly what their amygdala tells them to do. They sell, they run, they preserve what little they have left, and promise themselves they'll never make the same mistakes again. Buffett does the opposite. He sees panic as a sale. He sees fear as opportunity. He sees deep discounts as the best time to go shopping for businesses at attractive prices. This isn't just contrarian thinking. This is psychological arbitrage. While everyone else is making decisions from their emotional brain, Buffett operates from his analytical mind. While others react to headlines, he responds to fundamentals. While the crowd follows the herd, he follows the math. That cash position gives him something priceless in those moments. Freedom. Freedom from forced selling. freedom from margin calls, freedom from the desperate need to generate returns immediately, freedom to wait for prices that make sense. Think about what happened during the dot-com downturn. While day traders were watching their accounts decline, while tech stocks fell 90% from their peaks, while an entire generation of investors stepped away from the market, Buffett sat patient. He didn't panic. He didn't chase. He waited. And when the volatility settled, when valuations returned to earth, when quality businesses were trading for fractions of their intrinsic worth, he deployed capital methodically, not all at once, not in a desperate gamble, but systematically like a surgeon making precise incisions. The same pattern repeated in 2008. The same pattern will repeat in the next period of market stress, because human nature doesn't change. The technology evolves, the instruments become more sophisticated, the leverage increases, but the underlying psychology remains constant. Fear and greed still drive 90% of market decisions. Recency bias still makes traders believe current trends will continue forever. Confirmation bias still makes them seek information that supports their existing positions while ignoring contrary evidence. Buffett has learned to use these biases as fuel for his investment engine. When everyone else is optimistic, when valuations stretch beyond reasonable limits, when the market feels invincible, he becomes cautious. He starts building cash. He starts preparing for the inevitable correction. When everyone else is pessimistic, when prices have fallen below intrinsic value, when fear dominates every conversation, he becomes aggressive. He deploys that cash. He buys businesses that will compound wealth for decades. This timing isn't luck. It's not market prediction. It's psychological pattern recognition. Bull markets don't last forever because human euphoria eventually collides with economic reality. Bear markets don't last forever because human concern eventually encounters fundamental value. The cycle repeats with clockwork precision, but most traders never learn to profit from it because they're too busy reacting to it. They buy when they feel good about the market. They sell when they feel scared. Their emotions dictate their actions, and their actions determine their results. Buffett has inverted this relationship. He feels cautious when others feel good. He feels optimistic when others feel concerned. He's trained his mind to recognize emotional extremes as investment signals rather than reasons to follow the crowd. This inversion requires something most traders never develop: emotional discipline, the ability to act against your instincts when your instincts are wrong, the capacity to remain calm when everyone around you is stressed, the strength to hold cash when everyone else is leveraging up. But here's what makes this even more powerful. Buffett doesn't just wait for market downturns to deploy capital. He waits for downturns to deploy capital at scale. There's a difference between buying a few shares during a dip and moving billions of dollars when entire sectors are on sale. That $348 billion isn't just buying power, it's market-moving power. When Buffett decides to invest in a company during a stressful period, his investment alone can stabilize that company's stock price. His reputation can restore confidence in an entire sector. This creates a feedback loop that most traders never experience. The bigger your capital base, the better your opportunities. The better your opportunities, the faster your capital compounds. The faster your capital compounds, the more opportunities become available to you. Small traders can't access these dynamics because they don't have the resources to move markets. They can't negotiate the preferential terms that Buffett secured during the 2008 crisis. They can't demand 10% dividends on preferred stock. They can't structure deals that guarantee profits regardless of how markets perform in the short term, but they can learn from the psychology behind these moves. They can understand that the greatest opportunities emerge from the greatest market dislocations. They can prepare for those opportunities by building their own cash reserves, even if they're measured in thousands rather than billions. The principle scales perfectly. A trader with $10,000 who keeps 30% in cash has the same psychological advantage as Buffett, just on a smaller scale. They can deploy that cash when their favorite stocks go on sale. They can avoid forced selling during corrections. They can sleep soundly knowing they're prepared for whatever comes next. Most traders resist this approach because it feels passive. It feels like you're not really trading if you're sitting on cash. It feels like you're missing opportunities every day, that you're not fully invested. But this feeling is exactly what Buffett has learned to overcome. He's redefined what it means to be active in the markets. Activity isn't about making trades. Activity is about making the right trades at the right time with the right position size. Sometimes the right trade is no trade at all. This requires a fundamental shift in how you measure success. Most traders measure success by how much money they made today, this week, this month. They live in a constant state of performance anxiety, always worried about their latest results. Buffett measures success by how well he's positioning for the future. His time horizon isn't measured in days or weeks, it's measured in decades. He's not trying to beat the market this quarter, he's trying to compound wealth over the next 20 years. That perspective changes everything. When you're thinking in decades, daily market movements become background noise. When you're compounding over years, missing a few rallies becomes irrelevant. When you're building generational wealth, temporary underperformance becomes acceptable. This long-term thinking is what allows Buffett to hold cash without anxiety. He knows that cash today is opportunity tomorrow. He knows that patience today is profit tomorrow. He knows that discipline today is wealth tomorrow. The traders who mock his cash position are trapped in short-term thinking. They see only what's happening now. They can't imagine a future where current market conditions reverse. They can't conceive of a scenario where the stocks they're chasing today become the value traps of tomorrow. But Buffett has lived through enough cycles to know that reversal is inevitable. He's seen growth stocks become value traps. He's seen value stocks become growth stories. He's seen entire sectors rise and fall and rise again. This experience has taught him something profound. The market isn't a machine you can game. It's not a puzzle you can solve once and profit from forever. It's a complex adaptive system that constantly evolves in response to the collective behavior of its participants. The only way to consistently profit from such a system is to remain adaptable yourself. Not reactive, not emotional, not desperate, but adaptable, prepared, patient. That cash position is Buffett's adaptation to current market conditions. It's his acknowledgement that prices have risen beyond his comfort zone. It's his preparation for the opportunities that will emerge when prices eventually correct. He's not timing the market in the traditional sense. He's not trying to predict when the correction will come or how severe it will be. He's simply positioning himself to benefit when it does come, whenever that might be. This distinction is crucial because it separates genuine investing discipline from market timing speculation. Market timers try to predict turning points with precision. They go all in at bottoms and all out at tops. They're constantly adjusting their positions based on their forecast of what comes next. Buffett doesn't forecast. He prepares. He doesn't predict. He positions. He doesn't time markets. He takes advantage of the timing that markets provide to him. Right now, markets aren't providing him with opportunities that meet his criteria. So he waits. He accumulates dry powder. He earns low-risk returns on treasury bills while preparing for the day when those opportunities will appear. And they will appear. Not because Buffett can predict when, but because they always do. Market cycles are as certain as seasons. Bull markets always end. Bear markets always end. Euphoria always gives way to caution. Caution always gives way to optimism. The trader who understands this stops trying to fight the cycle and starts trying to profit from it. They stop reacting to market movements and start preparing for market opportunities. They stop chasing performance and start building the foundation for sustainable success. That foundation is built on cash, patience, and discipline. The same three pillars that support Buffett's entire investment philosophy. The same three elements that separate professional investors from amateur traders. The difference becomes clear when you understand what cash actually represents in Buffett's world. It's not money sitting idle. It's compressed opportunity. Every dollar in that pile carries the potential energy of a coiled spring, waiting for the precise moment to release its force into undervalued assets. Most traders see cash as dead weight. They calculate opportunity cost in terms of what they're not making today. But they're missing the deeper mathematics of wealth creation. The real opportunity cost isn't the gains you might miss by holding cash. It's the significant losses you avoid by staying liquid when everyone else is over-leveraged. Your brain fights this logic because it's wired for immediate gratification. When you see a stock climbing, dopamine floods your system. Your prefrontal cortex, the part responsible for long-term planning, gets overwhelmed by the limbic system's demand for instant action. You feel compelled to participate, to grab your share of the movement, to do something before the opportunity disappears. Buffett has trained his mind to resist this neurological pull. He's learned to separate the feeling of missing out from the reality of strategic positioning. When his amygdala signals about opportunities slipping away, his disciplined mind whispers about bigger opportunities waiting ahead. This isn't natural. It's learned. It's practiced. It's the result of decades spent watching markets cycle through the same emotional extremes, driven by the same human psychology, creating the same patterns of boom and moderation. Think about your last major loss. Not a small setback, the one that really hurt. The trade that kept you awake at night, that made you question everything you thought you knew about the markets. I'm willing to bet it happened because you were fully invested when you should have been holding cash. Because you were chasing momentum when you should have been preserving capital. Because you confused activity with wisdom. That loss wasn't random, it was predictable. Not in its specific timing or magnitude, but in its underlying cause. You were operating from scarcity when you should have been operating from abundance. You were reacting to fear of missing out when you should have been managing fear of overexposure. This is the psychological trap that destroys most trading careers. The belief that you must be in the market to profit from the market. The conviction that holding cash means losing money. The anxiety that comes from watching others make gains while you sit on the sidelines. But here's what that anxiety blinds you to. The sidelines aren't empty space. They're the best seat in the house for watching the game unfold. They're the position that allows you to see patterns that participants miss. They're the vantage point that reveals opportunities invisible to those caught up in the action. Buffett operates from the sidelines by choice. Not because he's afraid of the game, but because he understands that the best players know when not to play. In poker, the strongest players fold most of their hands. In boxing, the smartest fighters pick their spots. In strategy, the greatest planners choose their battles. Trading is no different. The best traders aren't those who trade the most, they're those who trade the best. They're those who wait for setups so obvious, so statistically favourable that success becomes almost inevitable. That waiting requires something most traders never develop. The ability to be comfortable with discomfort. The capacity to sit still while your instincts signal for action. The discipline to trust your process when everything around you suggests you're wrong. This discomfort has a name. It's called temporal discounting. Your brain values immediate rewards more highly than future rewards, even when the future rewards are mathematically superior. $1 today feels more valuable than $2 next year, even though waiting clearly makes more sense. Buffett has learned to invert this natural bias. He values future rewards more highly than present ones because he understands the power of compounding. He knows that patient money grows faster than impatient money. He knows that delayed gratification isn't just virtuous, it's profitable. This understanding changes how you view every market situation. When stocks are rising and you're holding cash, you're not missing out. You're positioning. When markets are falling and others are panicking, you're not losing opportunity. You're creating it. The psychological shift required for this transformation runs deeper than strategy. It touches identity itself. Most traders define themselves by their positions. They say things like, "I'm long Apple," or "I'm short the market." Their self-worth becomes tied to the performance of their holdings. Buffett defines himself differently. He's not long or short anything. He's a capital allocator. His identity isn't tied to any particular position, but to the process of finding and exploiting opportunities wherever they appear. This detachment allows him to make decisions based on logic rather than ego. When Apple became expensive relative to its intrinsic value, he sold. Not because he stopped believing in the company, but because the mathematics no longer supported the position. The stock price had risen beyond what the business could justify, so he reallocated capital to more attractive opportunities. This decision-making process bypasses the emotional attachments that trap most traders. They fall in love with their positions. They create narratives to justify holding losers. They ignore evidence that contradicts their thesis, because admitting error feels like admitting setback. Professional investors understand that being wrong isn't failure. It's information. It's data that helps you make better decisions in the future. It's tuition in the school of market reality. The only real failure is refusing to learn from that information. This learning requires something most people resist. Intellectual humility. The recognition that markets are complex adaptive systems that no single mind can fully comprehend. The acceptance that your predictions will often be wrong, regardless of how carefully you analyze the data. Buffett's cash position reflects this humility. He's not holding cash because he knows what will happen next. He's holding cash because he knows he doesn't know what will happen next. He's prepared for multiple scenarios rather than betting everything on a single outcome. This preparation extends beyond financial markets into the realm of psychology itself. Every day you spend watching markets creates neural pathways in your brain. Patterns of thinking become habits. Habits become automatic responses. Automatic responses determine your results. If you spend your days reacting to every price movement, you're training your brain for reactivity. If you chase every breakout, you're programming yourself for momentum addiction. If you panic at every correction, you're conditioning yourself for impulsive decision-making. Buffett has spent decades training different neural pathways. Patterns of patience, habits of discipline, automatic responses of calm analysis rather than emotional reaction. His brain has been shaped by years of successful long-term thinking. This neural conditioning isn't just about trading. It affects every area of life where delayed gratification creates better outcomes than immediate satisfaction. Health, relationships, career development, personal growth. The same mental muscles that allow you to hold cash during bull markets help you make better decisions everywhere. The traders who mock Buffett's cash position are revealing more about themselves than about him. They're showing that they can't conceive of a strategy that doesn't require constant market participation. They're demonstrating that their identity is so tied to trading activity that inactivity feels like losing momentum. But inactivity isn't losing momentum. It's preparation for life. It's the gathering of strength before exertion. It's the deep breath before the decisive action. It's the coiling of the spring before the leap. Right now, while markets continue their upward march, while valuations stretch further beyond historical norms, while leverage increases across the system, Buffett coils his spring. He gathers strength. He prepares for the moment when his patience will be rewarded with opportunity. That moment will come, not because he can predict it, but because it always comes. Market cycles are as reliable as ocean tides. They may vary in timing and magnitude, but they never fail to turn. Bull markets always end. Bear markets always end. Fear always gives way to renewed optimism. Renewed optimism always gives way to caution. The investor who understands this stops fighting the cycle and starts profiting from it. They stop trying to predict turning points and start preparing for them. They stop reacting to market emotions and start positioning for market opportunities. This positioning requires courage of a different kind than most traders understand. Not the courage to take big risks, but the courage to take no risks when everyone else is gambling. Not the bravery to chase momentum, but the strength to resist it. Not the boldness to act quickly, but the wisdom to act slowly. Slow money beats fast money over time. Patient capital outperforms impatient capital across cycles. Disciplined thinking produces better results than emotional reactions. These aren't just trading principles, they're life principles. They're the foundation of sustainable success in any field that rewards long-term thinking over short-term gratification. So the next time you see Warren Buffett sitting on $348 billion in cash, don't laugh. Don't call him outdated. Don't assume he's lost his edge. Understand that you're witnessing something most traders will never achieve. True mastery. You're watching a mind that has transcended the need to react. A psychology that has learned to profit from patience. A discipline so profound that doing nothing becomes the most powerful action of all. This isn't just about cash. It's about the courage to think differently when everyone else thinks the same. It's about the strength to stand still when everyone else is running. It's about the wisdom to prepare when everyone else is celebrating. The market will test this philosophy. It always does. Prices will continue rising while Buffett waits. Traders will continue mocking while he accumulates dry powder. The financial media will continue questioning while he positions for the inevitable. But when that inevitable arrives, when fear replaces greed, when heightened caution replaces euphoria, when the cycle completes its ancient rotation, those who laughed will remember why they call him the Oracle of Omaha. Your account may be measured in thousands, not billions. Your timeline may be years, not decades. But the principle remains the same. The mind that can hold cash while others chase returns is the mind that builds lasting wealth. The question isn't whether you can predict the next major downturn. The question is whether you'll be prepared when it comes. Warren Buffett already knows his answer. Now you need to discover yours.